June 30th, 2025. The FDIC's deposit insurance fund reserve ratio reached 1.36%, crossing the statutory minimum of 1.35% for the first time since the fund fell below that threshold in 2020. The DIF balance stood at $145.3 billion, covering approximately $10.7 trillion in insured deposits across 4,121 FDIC insured institutions. Mainstream financial coverage treats this as unambiguously positive news. The fund has recovered from the March 2023 regional bank crisis that cost $18.5 billion to resolve Silicon Valley Bank and Signature Bank. The FDIC ended its restoration plan in Q3 2025, no longer operating under statutory requirements to rebuild the fund. The message is clear. Deposit insurance works, confidence is restored, move along. Here's what the restoration complete narrative misses. The 1.36% reserve ratio sits 1 basis point above the statutory minimum and 64 basis points below the FDIC's own 2% designated reserve ratio target. That gap represents $68 billion in additional capitalization, the FDIC itself determined necessary to withstand a future banking crisis. More fundamentally, the reserve ratio measures the fund against insured deposits, but insured deposits represent only 61% of total deposits. The remaining 39%, approximately $6.5 trillion, is uninsured and depends entirely on FDIC resolution effectiveness and implicit Treasury backing. This isn't about whether the FDIC has done its job historically. Since 1933, no depositor has lost insured funds. That track record is real. This is about recognizing when the deposit insurance fund operates with inadequate reserves relative to concentrated exposure, and understanding what historically happens when multiple large bank failures occur simultaneously rather than sequentially. By the end, you'll understand why crossing the statutory minimum matters less than the gap to adequate reserves, how the four-stage deposit insurance stress cycle reveals when fund depletion risk concentrates, what $145 billion covering $10.7 trillion, a 1.36% reserve ratio, 1 basis point above minimum, and 39% uninsured deposit signal, why the S&L crisis, 2008-2009 financial crisis, and 2023 regional bank stress provide pattern templates for fund exhaustion, where today's reserve ratio and banking stress indicators place the system in the adequacy cycle, how deposit insurance fund depletion creates bank-run dynamics and Treasury backstop activation, the 7 signals showing stage 2 vulnerabilities despite crossing statutory minimum, why this hits uninsured depositors and taxpayers before any dramatic failure announcement. Let me show you the pattern that repeats every time the deposit insurance fund faces concentrated bank failures rather than dispersed sequential failures. Stage 1, fund adequately capitalized and failures rare. The reserve ratio exceeds the statutory minimum with comfortable margin, ideally approaching or exceeding the 2% designated target. Bank failures occur infrequently, perhaps 1 to 3 per quarter. The cost of resolving these failures represents a small fraction of quarterly assessment income. The fund grows steadily through bank premiums and interest earned on Treasury securities. Public confidence in deposit insurance remains unquestioned. Media coverage of the FDIC is minimal. Banking sector stress indicators remain benign. Capital levels adequate. Asset quality stable. Profitability healthy. This creates a virtuous cycle where strong banks pay modest premiums and the fund accumulates. This was roughly 2010-2019 as the industry recovered from the financial crisis and the fund rebuilt to a peak ratio of 1.42% in 2018. Stage 2, reserve ratio, falls below minimum and restoration plan activates. Either rapid deposit growth or increased bank failures causes the reserve ratio to fall below the 1.35% statutory minimum. By law, the FDIC must adopt a restoration plan to return the ratio to minimum within 8 years. The FDIC typically increases assessment rates on banks to accelerate fund growth. This creates procyclical pressure. Banks face higher costs during periods of stress when they can least afford them. Failed bank resolution costs begin consuming a material portion of assessment revenue. The fund still grows but more slowly. Public confidence remains intact because failures are manageable and the FDIC's resolution process works smoothly. This is where the system sat from 2020-2025. Pandemic-era deposit growth caused the ratio to fall below minimum in mid-2020. The 2023 SVB and Signature failures cost $18.5 billion, dropping the ratio to 1.15%. The fund just crossed back above minimum in Q2 2025. Stage 3, multiple simultaneous failures and rapid fund depletion. A shock, recession, asset bubble collapse, or crisis of confidence triggers multiple large bank failures in a compressed time frame. The FDIC faces resolution costs exceeding quarterly revenue. The fund balance declines rapidly. Assessment rate increases cannot keep pace with losses. The reserve ratio falls toward zero. Uninsured depositors at failed institutions face uncertainty and potential losses, creating contagion risk. Depositors at healthy but vulnerable banks begin withdrawing funds, accelerating failures. The FDIC's resolution process strains under volume. Asset sales from failed banks depress market values, increasing resolution costs. This is the 1980s-90s S&L crisis and 2008-2009 financial crisis pattern. Sequential failures become simultaneous failures. The fund designed for dispersed risk faces concentrated risk. Stage 4, Treasury backstop activation and taxpayer cost. The deposit insurance fund exhausts or approaches zero. The FDIC faces a choice: borrow from the Treasury through the federal financing bank, demand advance premiums from surviving banks, or request congressional appropriation. All three options represent de facto taxpayer support. Borrowing from Treasury makes explicit what was always implicit. The full faith and credit backing means taxpayers ultimately cover shortfalls. Advance premiums burden surviving banks during crisis, potentially triggering more failures. Congressional appropriation involves political negotiation and conditions. Public confidence in no depositor has lost a penny faces its sternest test. If the crisis is severe enough, even insured depositors may face delays in accessing funds. This is 1991, when the S&L insurance fund, FSLIC, exhausted and required $100+ billion in taxpayer funding. In 2009, when the FDIC fund went negative and nearly borrowed from Treasury. Where is the deposit insurance system today? Late stage 2, verging on stage 3 vulnerabilities. The fund just crossed the statutory minimum but remains far below adequate reserves. Regional bank stress from CRE exposure, consumer debt stress, and interest rate pressure creates multiple potential failure triggers. The system hasn't been tested by simultaneous large failures since 2023, and that test cost $18.5 billion against a fund that was larger than today's in absolute dollars. The savings and loan crisis of the 1980s and early 1990s provides the template for deposit insurance fund exhaustion through concentrated failures. Between 1986 and 1995, over 1,000 thrift institutions failed. The Federal Savings and Loan Insurance Corporation, the S&L equivalent of the FDIC, was established in 1934 with similar structure and purpose as the FDIC. The crisis built gradually through the 1980s. Thrifts faced fundamental business model problems. They borrowed short-term through deposits and lent long-term through mortgages. When Paul Volcker raised interest rates above 20% to combat inflation in the early 1980s, thrifts faced a mismatch. They paid 15-18% on deposits while earning 6-8% on old mortgage portfolios. This negative spread destroyed capital. Deregulation in the early 1980s allowed thrifts to invest in commercial real estate and other riskier assets. Many institutions, already weakened by interest rate losses, made aggressive CRE loans to generate income. When the commercial real estate market collapsed in the mid to late 1980s, these investments defaulted. The combination of interest rate losses and CRE defaults created insolvency on a massive scale. By 1987, FSLIC was insolvent. The cost of resolving failed thrifts exceeded the fund's resources. Congress initially provided $10.8 billion to recapitalize FSLIC, but this proved woefully inadequate. The crisis continued accelerating. Failures that might have been resolved cheaply in 1985 or 1986 became catastrophically expensive by 1988 or 1989 as asset values continued falling and supervisory forbearance allowed losses to compound. In 1989, Congress passed the Financial Institutions Reform, Recovery and Enforcement Act, which abolished FSLIC and created the Resolution Trust Corporation to resolve failed thrifts. The RTC received $50 billion in initial funding from Treasury, which eventually grew to over $100 billion in total taxpayer cost. Adjusted for inflation, this represents approximately $250 billion in today's dollars. The cause wasn't fraud or criminality alone, though both existed. The fundamental problem was concentrated exposure to commercial real estate and interest rate risk, combined with inadequate capital and supervision. When the 1990-1991 recession hit and CRE values fell, hundreds of thrifts became insolvent simultaneously. Sequential failures became simultaneous failures. The FSLIC was designed for sequential failures, 1 or 2 institutions per quarter with losses spread over time. When failures clustered, the fund exhausted within months. The pattern is clear. Insurance funds calibrated for dispersed sequential risk fail when facing concentrated simultaneous risk. The mathematics don't work when multiple large institutions fail in the same quarter. The 2008-2009 financial crisis nearly bankrupted the deposit insurance fund. Between 2008 and 2012, 465 banks failed. In 2008 alone, 25 banks failed. In 2009, that number jumped to 140. In 2010, 157 banks failed. The pace was relentless. Failures announced nearly every Friday afternoon as regulators closed institutions and arranged weekend resolutions. The cost to the DIF was enormous. The fund balance went from $52.4 billion in early 2008 to negative $20.9 billion in late 2009. This represented a $73 billion swing in less than 2 years. The losses came from multiple sources: direct resolution costs, as the FDIC paid insured depositors, loss-sharing agreements, where the FDIC absorbed portions of acquiring banks' credit losses, and administrative costs of managing hundreds of simultaneous resolutions. The largest individual failure was Washington Mutual in September 2008, with $307 billion in assets. JP Morgan Chase acquired WAMU in an FDIC brokered transaction that avoided direct resolution costs, but the near miss demonstrated how a single megabank failure could have consumed the entire fund. IndyMac's failure in July 2008 cost the DIF approximately $9 billion. Dozens of mid-sized regional banks followed. The FDIC faced a choice: borrow from the Treasury through the Federal Financing Bank as authorized by law, or find alternative funding. Borrowing from Treasury would make explicit the taxpayer backing that's always implicit, potentially damaging confidence. Markets might interpret Treasury borrowing as a sign the banking crisis was worse than acknowledged. The FDIC chose an innovative solution. It demanded 3 years of advance premiums from all insured banks. This raised approximately $45 billion and avoided formal Treasury borrowing. But the economic effect was identical to a bailout. Banks paid higher assessments during the crisis, reducing their capital and lending capacity. The cost was ultimately borne by bank shareholders, borrowers who faced tighter credit, and the broader economy that suffered reduced credit availability. The fund didn't return to positive balance until 2011. It didn't reach the statutory minimum reserve ratio until 2018, a full decade after the crisis began. During that decade, banks paid elevated assessment rates to rebuild the fund while simultaneously facing stricter capital requirements and reduced profitability. The procyclical nature of the system became evident. Banks had to strengthen the insurance fund during the period when they faced the most stress. The critical lesson: the fund works when failures disperse over time. Quarterly assessment revenue of $8 or $10 billion can absorb resolution costs of $2 to $3 billion without depleting reserves. But when resolution costs spike to $30 to $40 billion per year, as in 2009-2010, the fund exhausts. No feasible assessment rate can keep pace with losses from concentrated failures. March 2023 demonstrated how quickly concentrated failures deplete the fund. Silicon Valley Bank failed on March 10th. Signature Bank failed on March 12th. First Republic, though not technically failed, required FDIC-assisted acquisition in May. The direct cost to the deposit insurance fund was approximately $18.5 billion, $16.1 billion for SVB, and $2.4 billion for Signature. But the actual cost was higher because the FDIC and Treasury invoked the systemic risk exception to cover all deposits at SVB and Signature, not just insured deposits. This prevented contagion, but set a precedent. Uninsured depositors at these institutions received 100% recovery, not the typical pennies-on-the-dollar treatment in receivership. The FDIC later proposed a special assessment on large banks with uninsured deposits to recover approximately $15.8 billion. The reserve ratio fell from 1.27% in December 2022 to 1.15% in December 2023. The crisis erased 2 years of fund accumulation in 1 quarter. Had additional large regional banks failed in Q2 or Q3 2023, the ratio would have approached 1.0% or below, requiring emergency measures. The 2023 crisis revealed another vulnerability: the concentration of uninsured deposits. SVB held $173 billion in total deposits, with only $13 billion insured, and that's 92% uninsured. When these depositors attempted simultaneous withdrawal, SVB collapsed within 48 hours. Traditional bank runs involve physical lines at branches. Modern bank runs happen electronically. Wire transfers and ACH instructions execute in hours. The deposit insurance fund balance of $145.3 billion as of June 30th, 2025, represents 1.36% of insured deposits. This barely exceeds the 1.35% statutory minimum established by the Federal Deposit Insurance Act. The FDIC has designated a 2.0% reserve ratio as the long-term target since 2010, based on analysis of historical loss rates and the need to maintain a positive fund balance through banking crises. The gap between 1.36% and 2.0% represents $68 billion in additional capital the FDIC itself determined necessary. Put differently, the fund is 68% undercapitalized relative to the FDIC's own adequacy standard. The statutory minimum of 1.35% is exactly that, a minimum. It's not a target or goal. It's the floor below which the FDIC must implement a restoration plan. Why does this matter? The 2008-2009 crisis cost the fund approximately $90 billion in cumulative losses. The S&L crisis cost FSLIC over $100 billion. If a similar banking crisis occurred today with the fund at $145 billion, it would exhaust before resolving all failures. The 2.0% target of $214 billion provides a cushion to absorb major failures while maintaining positive balance and public confidence. The reserve ratio calculation itself presents issues. The ratio divides fund balance by insured deposits, but insured deposits, as of March 2025, represent only 61% of total deposits. The remaining 39%, approximately $6.5 trillion, is uninsured. These uninsured deposits are theoretically at risk if banks fail, but in practice, the FDIC often protects them to prevent contagion, as with SVB and Signature. This creates moral hazard. Depositors with balances exceeding $250,000 should bear risk, incentivizing them to monitor bank safety. But systemic risk exceptions mean they get protected anyway. The result is inadequate market discipline combined with inadequate insurance fund reserves. Acting FDIC Chairman Travis Hill has asked staff to analyze using the assessment base rather than insured deposits as the denominator for the reserve ratio, acknowledging this mismatch. Total insured deposits of $10.7 trillion are spread across 4,121 institutions. But concentration varies dramatically. The largest banks hold the majority of deposits. A handful of institutions each hold over $1 trillion in deposits. Hundreds of community banks hold under $1 billion each. This concentration means a few large failures can cost more than dozens of small failures. Consider the arithmetic. SVB's failure cost the FDIC $16.1 billion against total deposits of $173 billion. That's roughly 9.3% of total deposits as the loss rate. If a bank with $1 trillion in deposits failed with similar loss severity, it would cost the fund $93 billion, nearly depleting the entire current balance. 2 such failures would exhaust the fund. Large banks are better supervised and less likely to fail than smaller institutions. But less likely doesn't mean impossible. The 2008 crisis saw Washington Mutual fail with $307 billion in assets, the largest bank failure in U.S. history. Only J.P. Morgan Chase's acquisition prevented an FDIC resolution. If a top 10 bank failed today, the cost would overwhelm the fund. The fund's adequacy depends on 2 factors: the size of failures and the time distribution of failures. The fund can absorb sequential failures of moderate size indefinitely. This is business as usual. What it cannot absorb is simultaneous failures of large institutions. The current reserve ratio of 1.36% provides roughly 2 years of cushion if losses run at $25-30 billion annually. But a single quarter with $50-75 billion in resolution costs, entirely possible if 2 large regionals fail, would deplete half the fund. The FDIC's resolution process for large banks has improved since 2008. The agency conducts living will exercises for systemically important institutions. Resolution planning has advanced, but planning assumes orderly resolution over weeks or months. In reality, modern bank runs execute in hours via electronic funds transfer. By the time regulators intervene, deposit flight has often rendered the institution unsalvageable. Here are 7 signals to watch through 2026-2027. Signal number 1, reserve ratio falls below 1.35% again. The fund just crossed the minimum. Any shock, regional bank failures, recession-driven credit losses, could push it back below. A return to restoration plan status would signal inadequate cushion. Signal number 2, large bank fails requiring over $10 billion in FDIC resolution cost. This would consume 7% of the fund in one event. Multiple such failures in a year would threaten fund solvency. Signal number 3, special assessments on banks announced. The FDIC proposed $15.8 billion in special assessments for 2023 crisis costs. If additional assessments become necessary, it signals regular premium income cannot cover losses. Signal number 4, bank failures exceed 10 per quarter. This is roughly triple the normal rate. Sustained elevated failure rates indicate systemic stress rather than idiosyncratic issues. Signal number 5, FDIC proposes emergency borrowing from Federal Financing Bank. This authority exists, but hasn't been used since near miss in 2009. Actual borrowing would confirm fund depletion. Signal number 6, systemic risk exception invoked again. The 2023 decision to cover all SVB and Signature deposits set precedent. Another invocation signals the $250,000 limit is effectively suspended for large failures, increasing implicit fund exposure. Signal number 7, advance premium demand announced. The 2009 requirement for 3 years of advance premiums prevented Treasury borrowing but burdened banks during crisis. A repeat would confirm fund stress. Next episode, The pension crisis, how $1.5 trillion in public pension underfunding, 7.0% return assumptions in a 4% yield environment, and demographic shifts, forced benefit cuts, or tax increases within the decade. The pattern is documented. The sequence is clear. The only question is whether you recognize deposit insurance fund inadequacy before simultaneous bank failures force fund depletion, Treasury backstop activation, and taxpayer costs. This isn't about predicting bank failures. This is about recognizing when a deposit insurance fund operates at minimum statutory reserves rather than adequate reserves, and understanding what historically happens when concentrated failures test a system designed for dispersed sequential risk. The no depositor has lost a penny since 1933. Track record remains intact, but that track record required taxpayer bailouts in 1991 and near-bailout in 2009 when the fund exhausted.